What is going on, traders? Welcome to episode 3 of the Forex Bootcamp. And in today's episode, we are going to take a massive deep dive into fundamental analysis. So we spoke about it in the previous videos. Fundamental analysis is all to do with the macroeconomics, the fundamental reasons why currency prices are being moved up or down. Okay, but one thing I do want to let you guys know is that I am not a primary fundamental trader. I'm a mainly technical trader. I'm a more chart guy. And whilst there is a place in my trading for fundamental analysis, I'm not an expert on it. So the information that I'm giving you is simply going to be a bedrock that you can build upon. And there's definitely going to be definitely going to be a lot more information to it than this. But, for the average guy who's got no idea, this is perfect for you. You are going to learn so much, and I do believe you really are going to be inspired at the end of this video to see, how interesting this whole thing is. And hopefully it's going to provide you with a springboard for you to now go and do your own learning. But without further ado, let's get into it. So we are going to speak in today's episode about central banks, economic factors that drive price. We are going to look at the gold and the US dollar, real world events and their impact on price, such as crises, war, and booms. So let's kick it off with central banks. You've probably heard this term being flown around and probably have no idea what a central bank is. You know what a normal bank is. You know about Santander, you know about NatWest, you know about Lloyd's, right? So think of a central bank as the country's bank or the government's bank, the same way that you would see a normal bank in today's time, okay? It's their job to regulate the country's financial system and the country's economy, and every single country has one. The UK has the Bank of England, the USA has the Federal Reserve, and the European Union has the European Central Bank. The euro is a bit odd, right? Because you don't have a country for the euro. There are loads of countries that have adopted the euro. So the countries that are using the euro are in what's known as the Eurozone. And I don't know exactly where the European Central Bank is, but for this particular example, it doesn't actually matter, right? That it's not in like one specific place, because the European Central Bank governs the Eurozone, which is governing the euro across all of these countries. Now, I am not 100% certain about if you have countries like Spain, for example, who use the euro. I'm pretty sure that Spain would have its own central bank, okay? But that central bank might be governed by the European Central Bank. Not 100% too sure on that one. The euro is a bit of a unique example, so definitely go and research that. Okay, so how do they regulate the country's economy? Well, they will be tackling issues, they will be increasing stability, protecting the economy and trying to grow the economy. But the way they do all this is by doing state intervention if they need to. They don't always need to intervene to manage the currency of a country or the greater economic situation of the country, because those only happen in really desperate times. So if you look at something like COVID, where nobody was spending, every economy in the world was brought to its knees, and when there's no money flying around, that's a big emergency. So central banks will use various methods, but the most common methods that you would see in these times is called quantitative easing, which is where money is simply being injected into the economy. How do they do this? The central bank issue loads of loans and loads of bonds that can basically be bought by loads of institutions. So when they buy these, this money, then it's basically it can be sent out to the country, right? Other countries' central banks will they will print money, right? Such as America. And I'm not too sure about when economies are getting too big, but there definitely is some level of state intervention. Another method of state intervention is that they may halt all trading for their particular currency. I know that the Japanese yen did this about a year ago or so, where they literally stopped all trading because it was just getting so low that they couldn't afford it to go any further. Okay, what else do they do? And by the way, guys, these are all just examples. These are not all just exactly what they do. There's definitely a lot more, but like I said, this is providing you with the bedrock, okay? So what they also do is they purchase and hold vast amounts of foreign currency and gold. Why do they do this? They do this so that the government can spend, okay? Because remember that the central bank is the country's bank and also the government's bank, right? So the government may want money, the government may want loans, they will get it from their central bank. The UK government will get it from the Bank of England. What they'll also do is hold reserves to prevent shock in a financial crisis. So if something massive happens, they've got some kind of a buffer. they know they're going to be okay. They got some securities they can sell, they got some gold they can sell, and they probably have a vast amount of cash. And the last point that we're going to drive home about central banks, which you guys will probably be quite interested to know, is that they constantly release data to the public. You might be saying to yourself, well, I've never received any information from a central bank. Well, no, you got to go to their website. Yes, they have a website. Every central bank has a website, and you can go and look at all of their statements, all of their data releases, all of their speeches, all of their reports, and they will basically be telling you where they think the economy is going. They will be telling you their plans, and they will be able to give all this information out to you. Why is this important for you as a trader? Well, you are now able to gauge the direction of where this country's economy is going to be going, right? You need to be proficient in fundamental analysis in terms of understanding macroeconomics back to front, knowing how things are going to be affected. Because as you go through this whole video, this particular episode, the big message that we're going to drive home is that you need to see yourself as an investor, and the things that you want to sort of invest in are countries, okay? You are thinking of, you are putting your mind in the investor. So you're putting yourself in the investor's mind who wants to, expand their business, wants to build factories, wants to build plant and machinery, wants to have operations in a different country. Heck, they may even just want to purchase that currency. Okay, how do you know if a currency is good? Well, you look at all these factors, okay, that we're going to be talking about, and central banks are very important for you to gauge that idea because of the amount of direction that they provide and where they're going to be going. They're going to be giving you a lot of clues and a lot of indications as to where the economy is going, and therefore whether you think that this current currency is going to rise or fall, due to the fact that investors will want to choose to invest here, or they want to be pulling their money out. Like I said, guys, it's going to be a big one this episode, so make sure you're taking notes and you're taking it slowly. But don't worry, I'm going to be here every step of the way, making it very simple for you. But that's central banks covered. The other thing that you're going to need to be very aware of when you're thinking of fundamental analysis, and to be honest with you, any kind of trading in general, is that you really need to have a very good understanding of the law of supply and demand, because this is at the heart of all trading. Not just stock trading, not just Forex trading, not just crypto. I'm talking every kind of trading. Okay, the guy who's selling sandwiches, the guy who's selling services, the guy who's pricing his MOTs, okay? The reason why supply and demand is so important is because price always follows this rule. If something is in high demand, the price is going to increase. If it's in low demand, the price is going to decrease. If you have something which is in very high supply, the price is going to be decreased. If you have a very low supply and it's a very rare item or service, then you're going to have an increase in price. Okay? So you probably understand this, but you might be thinking to yourself, well, why is that the case though? Like, why is it that prices rise when, there's demand, or why is it that prices fall when there's high supply? Well, let me just give you this example, okay? It's just simple economics, right? People don't it's not like it has to happen, but it just does happen, okay? And I'll explain why it happens right now. Suppose that I am a bookstore owner, and I got 5 books that I want to sell. And in front of me, I got 5 people who want to buy the book. It's very fair to assume that I can price these at £10 each. People, £10 each. There we go, job done. Okay, but what's going to happen now if I've got 30 people now who want to buy this book? I've only got a limited supply and the demand is really high. So I'm going to have to increase my prices. Do you see what I mean? I'm not going to put them at £10. I have to increase my prices. I'm going to put £100, per book now. But now let's say, for example, that I've only got 2 people in the store and I've only got 5 books. Well, if they want to buy, I need them to buy it. So if I want them to buy my book, I'm going to have to drop my prices a little bit. So that's basically how it kind of works. And then the last point about supply and demand is that it's not so much the fact that causes prices to rise. It's all down to people's reactions to them, okay? You guys have probably seen it time and time again. You will see something on the news. You will hear something like Morrison's is running out of bread, or KFC is running out of chicken, or something, right? Even though the KFC thing was true, but the point is, it could be like a very small detail, or maybe something that got taken the wrong way, or maybe people just don't have the facts yet, but people will hear that and they'll think, oh my God, I need to go out now and get bread. And you'll see droves of people go to the shop. And it's like nothing's even happened, but it's because fear is such a strong emotion, right? It's not so much the actual fact. Morrison's may well have had a surplus of bread. They might have too much bread. Maybe a fake news story came out, or maybe somebody wanted to just cause a reaction in the press. Maybe someone just wanted to sell a bunch of newspapers. People see that, people believed it, and then people went out and bought the bread. Okay, so a situation like this, what would happen? Well, I mean, it's a very extreme example, but if everyone was buying bread, then obviously the price of bread's going to go up. Okay, and if we talk about the reason why this happens is because, you got higher demand. So the reason why prices rise and higher demand is because people are now got to produce more, so they got to charge more. So that's basically how it all works. Okay, and but likewise, think of it like this: if good news spreads around a product, it might not even be that great. It could just be some shitty little fidget spinner, but like everyone's going crazy about it, right? Everybody wants one, then everyone's going to buy one. That's going to drive the price up. So you got to think about how are people going to react to this kind of thing. Right then, looking at economic factors that influence currency prices. Now, this is just a general outlook, okay? This isn't all of them. You're going to have to, do your own research. Like I said, I'm not a full expert on this. However, this is going to provide you with a great insight. Even if you just use this, I probably have confidence that you would be able to compute some very good analysis. Okay, so let's kick off with it. Gross domestic product. You've probably heard this time and time again without really knowing what it is. GDP, right? It is the value of all goods and services produced by a country in a specific time period. And what it simply means is that it is the market value of all goods and services sold in a country. Okay, we're not talking about created, we are talking about services and goods that have been sold. I am talking about the coffee mug that you bought. I'm talking about the book that you bought. I'm talking about the haircut that you got. I'm talking about the nails that you paid for your missus, or the BBL you paid for your missus, or the notebook, or whatever it is. Anything that is sold will have a value, and that gets that gets put into the GDP of that country. Okay, but why is GDP important? Well, think of it like this. If you've got a country where everyone's buying shit, wouldn't that signify that country's doing pretty good economically? And likewise, if no one's buying anything, so therefore the GDP is pretty low, then it's pretty like low growth, or the economic activity isn't that high. Well, if you're an investor and you want to put a machine somewhere, sorry, you want to put a factory somewhere, you just want to invest your cash in a country, which country are you going to go for? The country that's got really high GDP or the country that's got really low GDP? Makes sense to put it in the high GDP, right? You want to get bang for your buck. You don't want to put, you don't want to put you don't want to invest in a country that's got low economic activity. That just doesn't make any sense, right? But another factor that you got to be very aware of is that we're going to talk about these words very often: high, low, rising, and falling. Okay, why is rising and falling quite important? Well, what it means is, right, the reason why it's important is because even if a country has even if a country has low GDP, then what it also means is, sorry, if a country has low GDP, but we can see that the GDP has been rising for a certain period of time, this may indicate that the country is growing economically. So even though the GDP is pretty low right now, we can see something here. Do you know what I mean? And maybe this is going to be a world player in a few years, or maybe it's a good opportunity for investors because maybe they can get, an investment on the cheap, right? It's like buying a stock before it's kicked off. It's a bit low right now, but you want to buy it when it's low, right? So that's another thing to consider. And also, if you've got a country that has very high GDP, but it has been, the GDP has been falling, just because even though it's got a really high GDP, maybe it could have the top 10 GDP in the whole world, but because it's falling, we may not want to invest in that country, or may want to pull our money out of it because it's falling, which is signifying economic contraction. Okay, hope that makes sense. Right then, looking at interest rates, this is really, really important, okay? There is a typical rule that you are going to have to follow throughout your trading career, and it goes like this. When central banks announce interest rates, typically, if interest rates are rising, then that currency will increase. And if those interest rates are falling, then that currency will decrease. But it also has to be within the mood of the whole world. I like to go back to COVID as an example, because everyone's economic stats were pretty bad, right? But no one really cared because everyone was doing really bad because the whole world was in lockdown. Do you see what I mean? So you got to have it in context with the current times. And the current times are normal and stable. And yes, countries are now, America is saying it's going to rise its interest rates. You better believe that the current, the US dollar is probably going to increase, okay? And vice versa if it says it wants to lower interest rates. But why is this even a factor? I mean, what the hell even are interest rates? Some of you may be asking. Okay, interest rates very simply means that the money that you can earn from savings and loans. Okay? So we're talking about central banks now. Remember, the central bank is the country's bank, okay? These are the guys that govern how much banks can loan. And these are the guys that govern how much the savings rate is for each bank. So every retail bank, like Lloyd's and NatWest, they have a bit of wiggle room, but it's essentially like the ceiling is set by the central bank, okay? So that's pretty much it. If you've got high interest rates, you're going to get high returns on your loans. Bearing in mind, they might be more expensive. But if you're giving out loans, you're going to get higher returns, and you get higher returns from your savings. Vice versa. If you've got lower interest rates, you're not going to get much for your savings, but you can get a loan pretty cheap. However, people who are selling loans, they're not really going to get much bang for their buck. Inflation. Okay, this is a bit of a tricky one, but I need you guys to work with me. I'm going to break it down to you super simple. Okay. Inflation is nothing more than the increase in prices of goods and services over time. Put very simply, over time, everything that you pay for is going to increase in price. It just is. And people think inflation's bad. It's actually not. Inflation simply is a natural cause of economics. It just happens. When you go back and think, oh, Freddos were 50p a bar, now it's £2. Oh my gosh. Yeah, but like, you got to put it in context with the whole world. Wages were actually lower back then. And things are more expensive now, but I think the minimum wage is like £12 an hour or something. Whereas when I was 21, the minimum wage was like, I don't know, £8, £7 or something. So it's not a bad thing. What is bad is when inflation itself gets bad, okay? Because when inflation gets too high, the goods, the prices are increasing too much, then we've got a big problem. Obviously, we've got a big problem, okay? Because people can't afford things. And the worst thing that the governments can do is just print a shitload of money. Look at Germany and hyperinflation during the 1920s, I believe it was. Or, early, maybe before the 1920s. I'm pretty sure the 1920s. I can't remember. But it was terrible, right? It was getting so bad that it was like, I think $1 was equal to like 3 trillion marks. And like a loaf of bread was like 200 billion marks or something crazy. It's like the value of money completely evaporates and goes away, right? But the thing is, if you're able to control it, then it's fine. And that's why central banks aim for around 2% inflation rate. Okay? So what causes prices to increase? And what can the effect of inflation have on these investors or currency prices? Well, let me tell you. High inflation is generally caused by the increase in wages that people earn. So therefore, they're able to pay for more stuff, which in turn is going to cause an increase in demand. So therefore, people are going to increase their prices. And the way the prices get increased is because it follows the whole supply chain. Because if we are in the UK earning more money, we are spending more money, right? We are buying more things. If prices stay the same, right, we're probably going to end up earning more money. We're probably going to get better jobs at some point. And typically people just end up earning more money, pay rises and whatnot. There's other businesses that have to make money too, right? If we're buying sandwiches from the shop, then we've got to also think about Tesco's and how they're packaging their stuff. We've also got to think about the electricity that it's costing them. We've got to think about their suppliers. We've got to think about the guys who are making the bread. We've got to think about the factories who's making, processing it all. Then we've also got to think about the farmers, and we've got to think about who we're shipping it from. So when we have an increase in demand, if we are telling now a company, well, we need more sandwiches, they're going to have to work harder and they're going to have to produce more. So therefore, they're going to have to increase their workload. And therefore, everything's going to be ramped up a little bit. So when you need more work, you're going to have to probably pay a little bit more because you're going to be using more machinery, more people, more time, more etc. And that basically just goes all the way down to the sandwich. From the guy farming the chickens all the way down to the sandwich, right? And it's just a natural occurrence, all right? And it's actually not too much of a bad thing, really, because you kind of want good inflation because it's showing you that the economy is moving normally, right? The problem is when it gets too high or too low, okay? Because too high, it means that the value of money is going to decrease over time, and nobody wants that. Obviously, you've got a bunch of hard-earned cash in your bank. Imagine if by tomorrow it's just worth nothing. That's why they got to control it. But how does low inflation, is a problem? Well, if people aren't spending, right? If the inflation rate is really low, then that means that there's nothing going on, bro. No one's spending because no one's probably getting paid good. So there's nothing going on in the economy to cause that, right? So that is a big problem in itself. You just want to find that middle ground. You don't want to be too high or too low. So when you're thinking about your fundamental analysis, look at the inflation rate. Is it rising? Is it falling? Look at the whole system, look at the whole world, and then you can start to paint the picture. Okay, moving on to employment. Simply put, how many people are in work? You guys can understand that. Simple. If we have good employment levels, it means more people are working, it means more people are earning, therefore more people are spending, which means businesses are running well, people are getting what they want, people are making money, people are spending money. The flow of money is going around the economy extremely nicely. When you have a good level of employment, it's very obvious you're going to have a stable or, signs of a strong/growing economy. But and again, you have to piece it with the world situation. I like to go back to COVID. Everybody was out of work in COVID. Every single country in the world had shocking levels of unemployment. But we weren't looking at these countries and thinking, "Oh my gosh, like look at America. It's got such high unemployment. We're not gonna invest there." Because you look at France, you look at Portugal, you look at Spain, you look at America, you look at China. Well, China, they were back in bloody 2 weeks. But we ain't going to talk about that. You know what I mean? We're going to talk about that. But you see what I mean? The whole world is on its knees. So no one really cared about these things. Okay? But again, we're looking at the whole situation of the world. We're looking that it's pretty normal. If we see rising unemployment now, we're going to be thinking to ourselves, shit, like what is going on here? Excuse my language. Why are people out of jobs? And why is this a problem? Well, it's a problem because if people aren't in jobs, people aren't paying. People aren't earning. Therefore, people aren't paying. People aren't living their lives. The economy is not doing well. That's why it's a problem if you have rising unemployment. You need people in work because you need the money to be flowing around. It's like the lifeblood of a country is money. It has to be flowing and pumping. Okay? Rising employment or falling unemployment is also good for the economy. Why? Because less people are out of jobs, more people are in work, and people are paying, earning, and it's probably, if you have rising employment, then it's just a good sign for the economy. We may be in a potential boom, maybe a global boom, or maybe the country is just doing well after a bad period. Right then, moving on to politics. Governments have a very strong power to affect markets for a number of reasons. The first one I want to go over is their fiscal policies and their overall agendas for the country. Let's talk about fiscal policy. What the hell is a fiscal policy? You might be asking me. A fiscal policy is like a financial policy that governments will have towards the country in regards to its economy and the use of tax and government spending. Right? It's how they're going to be spending, how they're going to be taxing, and where they think the government is basically going to be going. This is important because different governments have different views on economy and have different plans for the country. So, if you have a country whose government is seen to be quite dovish, which means that we want low rates and slow growth, people may be a little bit skeptical. People probably don't want that. But then again, we've got to piece it with the current times. Okay, why are they dovish? Okay, dovish maybe because that's their general outlook, or dovish because maybe the economy is growing too much. Remember what I said? We don't want to be in either end of the spectrum. Yes, growth is good. Yes, growth is fine, but we don't want too much of it. We also don't want things to slow down too much. We want to meet in the middle. So dovish means we've got low rates and slow growth. Okay, we're taking things slow and chill, maybe pulling back a little bit. Hawkish. By the way, these are two words you're going to see a lot when you read these economic reports. Hawkish means that we've got high rates and high growth. We want to move fast. We want to pump, we want to boom. Okay, but also it could mean not necessarily that, but maybe we're coming out of a slump and we need to drive the economy higher now. We've come out that bad period and we need to drive it higher. These aren't necessarily good and bad. Okay, I would probably say that in general, hawkish views probably garner, increase in currency rates, currency value, whereas dovish probably be seen as, decreasing the currency value. But again, it's got to be pieced in with a bunch of other information. Okay. The other thing we've got to be aware of is the government's overall agendas, okay? Typically, how are they? Like, how are they seen? How are they seen to act? Are they going to be good for business? How is the market going to react? And that's always the big question. How is the market going to react? Because I remember looking at the election for Trump and Biden, and I was really certain that when Biden was going to get elected, the markets would tank. I really thought that the market really wanted Trump to win, for example. But then when Biden got into power, I'm pretty sure that the US dollar kind of boomed, but I don't know why it did. Or maybe it didn't. I can't really remember, to be honest with you. But the point that I'm trying to make is that we can have an idea about the new government and the head of state, but we've got to basically see how the markets will decide that. Okay, because we may think that Trump is a racist, Trump is this, Trump is bad, Trump is whatever, but you could see the US dollar skyrocket on the announcement of him coming in. Maybe it's because he's good with business. We just don't know. Okay, but what you've got to be very aware of is when we look at political unrest. Okay, if there is a strong, turbulent political issue going on, that will cause markets to move. And why will they move? Because the markets don't like uncertainty. And this is something that you have to remember very, very well. Markets do not like uncertainty. If there is any kind of uncertainty, it will cause moves. It will cause, certain currencies and certain assets to tank. And we are going to speak about this now. Okay? Oh, actually, before we go and do that, maybe this might be good for you to kind of just rejig your memory a little bit, maybe just refresh a little bit, maybe pause the video and just kind of take a 1-2 step to have a look and say, okay, I get this, inflation looks good, I'm keeping up with what Mr. Joseph is saying, okay? Or you want to go and do your own research for a little bit, you don't have to watch the whole thing now, maybe give it a pause, because the second half of this video is going to be packed with a bunch more information. But there is something that I want you guys to note down in your notebooks, and it's going to be this. Look at the economic calendar. The economic calendar is simply a calendar for all the news releases, all the data releases that central banks are going to be offering. Okay, so you are going to be looking at, I'm pretty sure it's all central banks, don't quote me on that, but it's basically the economic data, and they're grouped into 3 folders: low impact news, medium impact news, and then high impact news. Okay, so why are the high impact news important? Well, they're very volatile. Trading conditions around this time are very volatile because these kind of reports, these kind of data will be things like CPI, which is the Consumer Price Index. It's a massive, massive data, which is an inflation indicator. There is GDP. There is things like unemployment claims. There are so many things that come out that the economic calendar has, and it's for every single country. Every single country that you can think of will have this data release, and it will be scheduled in the month. Okay, so as well as this, try and have a look now at real world events. Think about everything that we've spoken about. Try and find some economic crashes, economic booms, look at the markets, look at what happened. Maybe you might have a specific case study that you could be interested in. Maybe you're very interested in, I don't know, Britain, America. Maybe you're interested in China, Japan. You can go ahead and look at the price charts, right, on a website called tradingview.com, which will be spoken about at the end of this video, and you can go ahead and have a look yourself. If it's a bit daunting, then maybe just don't take it too far, don't take it too fast, just chill with it, consolidate what you've learnt, and then we can go on and be a little bit more adventurous with our studies. Okie dokie, let's go ahead and have a look at the US dollar and gold. So these are safe haven assets, okay? Safe haven assets are simply the safe bets, okay? These are the things that people want to hold on to in terms of scary times. Why? Because they can be redeemed and they seem to hold value, okay? And typically gold and the US dollar are the most important and probably the strongest safe haven assets, okay? So why was it specifically these two though? Why was it not the Chinese yuan? Why was it not silver? Why was it not, I don't know, plutonium? Is that a metal? Or is that radioactive material from The Simpsons? I have no idea. I think it is, I think it is the radioactive material, the plutonium rod from Mr. Homer. Let's look at gold, the history of gold. Gold was the first currency to be traded. I put in inverted commas, currency, okay? And gold has been used since 550 BC. And before commodities were traded before currencies. And gold was traded because it was valuable, it was beautiful, it was rare, and that's why people traded it, because it had a lot of value, because it was simply rare. But today, we don't really trade gold like that. We don't have a little bag of gold coins that we're going to go and exchange for a nice mithril sword and go to Lumbridge and go and slaughter some, some cows. You know what I mean? Talk about RuneScape, my boys. Do you mean it's a bit different in today's world? So let's go ahead and look at that. So we've got to look at something called the gold standard, okay, which was first introduced by the UK in 1821 and the USA in 1871, right? And officially in 1944, the Bretton Woods Agreement was signed, and it basically meant that gold and many other currencies were going to be pegged to the US dollar, okay? If you don't know what pegged means, when we talk about currencies, we are simply what we mean is that if we have something pegged to something, it means that it's simply stuck to it, okay? Like it follows it. So the reason why people pegged their currency to the US dollar was because it was so strong. So even if there were turbulent times, whether it was going up or down, we were following the strongest currency. So it didn't matter how much we went up or down by. Our currency was made stable because of the fact that we were pegged to the US dollar, right? And the thing is, currencies were also backed by gold. So the reason why these currencies had value is because they had gold behind them, right? And the reason why they did this is so that they could stabilize currencies, they could prevent inflation from occurring, and also since governments couldn't manipulate the supply, they couldn't say, "Oh, we got like $500 million now. Okay, where's the gold for it, pal?" That's what they'd be saying. Okay, but the thing is, this got abolished in 1971, and the reason why they did that is because they wanted to prevent nations from burdening the system by redeeming gold. So what does this mean? Well, if someone had a massive store of gold, or everybody wanted to cash in their gold, then maybe we'd have a problem. Okay, maybe they couldn't pay out fast enough. Maybe there would just be too much pressure to pay these people. It also caused constraints from government, so they weren't able to like freely transfer money because of this issue with gold. So what happened was currencies were converted to the currencies we've got today, which is called fiat currencies. So the euro, Australian dollar, Chinese yuan, everything, they're all called fiat currencies because they're not backed by anything, not backed by gold. I don't know if that's what fiat means, but they're called fiat currencies. And they're not backed by gold. They're not backed by anything other than public confidence and faith. But this allows for a much easier flow of money. We can transfer between each other. Governments can print money if they want to. They just have to be smart about it. So let's look at the US dollar, otherwise known as the greenback. So the US dollar, amongst other currencies and commodities, is considered a safe haven asset. And the US dollar was always seen as a safe bet due to USA's strong economy. Oh, 2 seconds, guys. Bear with me. There we go. Sorry about that. So the US dollar was always seen as a safe bet due to USA's strong economy. And USA through the 1900s proved to have an immense industry and grew to be the largest economy in the world. And this is why the US dollar is so important and why it's been so valuable for so long. The confidence in the USA economy is massive, hence the massive confidence in the US dollar. And during global unrest, people will turn to these safe haven assets, and this is why it's so important. What they will do is convert their current currency into safe haven assets such as gold and the US dollar. Okay, so this will increase spending to a particular asset, which means that the demand is increasing, which also means that the value increases. So if we take this particular example, if we have a very scary time, we're going into World War III, all the rich guys are going to dump a bunch of money into gold in the US dollar, and it's going to cause the US dollar to spike massively, and it's going to cause the price of gold to spike massively too. And conversely, when the catastrophe is all over, it was all just a big scam by the government, and people feel more safe, they're going to exchange their US dollars and gold back to their currency, which is likely to decrease the value of the US dollar and also decrease the value of gold. Why? Because we're selling that particular asset. The demand is lowering, and we also have a increased supply, so the value decreases. So let's go into some real life examples. So we just talked about it, crises, a big scare to the world. Remember this word, uncertainty. If ever you see anything in the news which will, cause some kind of uncertainty, the reason why I say at the top right there, global or local, basically refers to, is this going to be a global thing or is we just talking about a specific country? And the reason why this is important is because if we are looking at a global situation, then we will probably see massively a big move in gold in the US dollar. But if it's just a local move, like if we are simply just speculating on certain countries and we see in, I don't know, like the Isle of Man, no, that's a bad example. Like, for example, something happens in Tonga, like in Tonga, a bit of a random place, but there's a big news event that's come out. Maybe we can go ahead and look at the US dollar in regards to the Tonga. I don't know what currency they use in Tonga. We can go ahead and look at the relationship there. We're specifically focusing on with that one aspect. We're not really looking at it from a whole big perspective. I doubt that a crisis in Tonga would cause massive moves in gold. That's just my opinion. I don't know. But yeah, uncertainty. Global investors don't know what's going to happen, and that's why it affects these, it causes these big moves. So you got to think of the economy like contracting. Hang on a minute. Why did I put that there? Think of economy contractions, rapid expansion, just as bad since... Okay, so when we think of economy contractions, right, Rapid expansion is just as bad since devaluing money is occurring, which is also very scary. Um, yeah, I don't really know what I meant by that point. Let's just ignore that point there, okay? I don't know what the hell I was talking about. Probably thinking too much about COVID. Um, but yeah, we spoke about it. US dollar will increase in value, and almost always gold will increase. Why? Because their currencies are being dumped and gold and US dollar are being purchased at large. So, another aspect that causes big uncertainty and reasons why safe haven assets will increase in value is war, because no one likes war. War is very scary, and the reason why safe haven assets get purchased is because it protects them in these times. Okay, because markets will react uncertain with a lot of uncertainty, and we want to just simply act with confidence that we're going to be okay. So we're going to purchase these things, and when it all blows over, we will then, convert our currencies back or whatever. And the US dollar could rise or fall depending on the situation. You always just need to study market behavior. Market behavior. I need to spell that properly. So my apologies there. So yeah, market behavior would need to be studied. So it's not always a textbook move. What I mean by this is that we can have all the textbook answers being laid out to these questions, but the markets could, kind of do the opposite. And I'm not saying that's why it happens, right? I'm just saying that because I don't know. Maybe I just need to study a little bit more. Maybe there's some other factors, and that's where your own research will come into play. All right, then, let's talk about something a bit more positive. We've talked about war, we talked about scary times, uncertainty. Now let's look at the importance of booms, okay? So this is times of economic prosperity. We are bullish. Bullish, bullish, bullish. What does bullish mean? Bullish means that we are on the up. Prices are rising. And just as a side note, bearish means that everything's going down. So bullish market means that prices are rising. A bearish market means prices are falling. So in bullish markets, in booms, we got bullish markets and companies are doing well. Wages are increasing. People are spending. Everyone's having a good time. People are going out. People going on holiday, having a nice time at the lake with a few little ice creams, yada, yada, yada. Life is lovely jubbly. Very, very good. Global economies are doing well. Specifically, the USA and the West, you will see nice increase in value of the US dollar. And in these times, though, gold is probably going to decrease in value or maybe maintain price because times are so good, no one's really worried. Does that make sense? So we've got these good times, so why would people need to purchase these safe haven assets? Unless you've got a bunch of these pump and dump traders which are gathering together and just manipulating the price, but that's another whole thing entirely. You don't even need to worry about that. All right, then, this is pretty much going to finalize the whole thing. But before we close the book on this episode, let's go ahead and just take a look at fundamental analysis right again. Okay, fundamental analysis is the backbone of why currencies move and is all to do with supply and demand. Everything that you're seeing, all the information is going to have to be put in terms of supply and demand. When we look at central banks, okay, these are the guys that offer all that information, and they're very important in fundamental analysis because they're the guys who regulate the financial system and the economy of that country. So therefore, you need to know what they're thinking and what their plans are. Economic factors that drive price, a few examples. We got GDP, the increase of prices, the market value of all this goods and services sold in a particular country over time, inflation, which is the increase in prices of goods and services over time, and then we have interest rates, which is simply the rates you're going to get for savings accounts and loans and maybe other securities. US dollar and gold, safe haven assets. These are the assets that people will turn to in terms of uncertainty. Their value will increase when times get uncertain and scary, and they will decrease when things kind of get okay and a little bit better. All right then, guys, well done for sticking with it to the end of that video. Now is a perfect time for you to go back and consolidate everything that you've learned, because after this, we are going to jump into technical analysis. This is probably going to be the most exciting part for all of you. It's all the chart work, and it's going to be a multi-part series. It's not just one video. We're going to have multiple videos. We're going to teach you how to read charts. We're going to teach you how to analyze the market, how you're going to be placing trades, okay? So it's going to be a massive piece. We're going to take it bit by bit. So get prepared. And before we get started and you get started, I need you to go and check out this website. I did speak about it earlier, but you need to go and look at it. You need to understand it. You need to know how it works. So go ahead and have some fun with it. It's a free website. There are some paid services in there, but you're not going to need that right now in your particular journey. You just need to use the website and get comfortable with it. So it's very awesome because you can plot analysis. You can just have fun with it. and you can simply look at price charts, and you need to have it probably on the side as you're watching this video, because I will go through it all with you. When you see me doing these chart work, I am simply on TradingView. Okay, so you guys can literally copy what I'm doing. You can study what I'm doing on the charts that I'm using. And it's very simple to use. It's a really, really good website. It's the reason why it's the leading, it's the market leader in that. But guys, thank you so much for watching. I hope you've enjoyed. Leave a like, leave a comment, put a subscribe if I've taught you something, and I will see you in the next video. Take care, guys. Have a lovely day.